And finally, we come to part five, where we're going to treat a few subjects. We're going to treat the subject about audit, financial reporting, and also risk and oversight. Yeah. So the first question I wanted to ask you, Patrick, we've heard so much about audit committee uh, that are under pressure now more than they have been. Now, the question is, how can they be really effective? How can they really play the role really well and not just being reactive in your view?
Yeah, well, I mean, I would go back to that triangle of purpose, people, and process. I think in terms of effective and efficient, um, I think you have to be really clear what the focus of the audit committee is, or if it's an audit and risk committee, the audit and risk committee, and we'll come back to that in a minute. And the basic thing is to ensure. I think this is where the chair of the audit or audit and risk committee and the chair of the nominations committee have a coordinating role. You have to make sure you have the right CFO, and you have the right focus within the finance function, an internal audit function if you're big enough to have one yourself, or an external audit function. You have the right auditors, and you have the right, if you're a quoted business, you have the right financial advisors so that you are not just giving the market the information that they need to make informed assessments of the company and to invest in it, but also that's a smooth process, and it balances the needs of different stakeholders. So I think if you take over the role as chair of an audit committee, then you really need in your first meeting to be absolutely clear with the rest of the audit committee and the board as a whole what the role of the audit committee is. Also, there is a lot to do. There are a lot of pressures, changes in regulation, changes in accounting practice, the business environment, the whole way that businesses plan and report. The technology has improved a lot. The pressure to have real-time reporting, where feasible in many businesses is quite significant. The rise of dynamic budgeting, things like that really are important for audit committees to get their head around. So there's a lot to potentially think about. So it's what's the right focus. And also, if you're on an audit committee, you don't want to think about just this year's accounts, just assuring that this year's the financial control systems are effective and risk is managed properly and so on. You kind of have to have a view of the strategy, where the business is going, and actually, are we set up to cope with that growth in terms of the financial management, financial reporting? So I think the purpose bit is really important. Clearly, having the right composition, the right people on the audit committee is really important. And if we look at, should you have an audit committee and a risk committee, or should you combine the two? One of the challenges at the moment is I think most audit committees are populated by, understandably, financially oriented people, whereas most of the big risks are non-financial. Everything ends up in a financial risk, but most of the big risks, are the non-financial things. And do you have the right people, in the audit and risk committee to balance that, focus on the audit side, the assurance side, and the risk side, which is, one is more looking at today, looking backwards, the review point and making sure the financial systems are right for the future, and the other is more forward looking in terms of risk. So I think there's that. And then, are you efficient? Are you effective in that sense? So have you got the right processes? Have you got the right relationship with the different people that you need to have so that you can help make them more efficient too? Lots of people chew up a lot of time through the audit process, in arguing with the auditors. Actually, a good CFO will anticipate the issues where there may be differences of view, where there may be challenge, and you will have thought through those before you encounter the issue, rather than later. So I think there's a lot in that. It's a simple question. There is a lot of pressure, but I think through clarity of purpose, aligning everyone behind what that purpose is, through getting the right people on the audit committee, the right advisors, the right people in the executive team, and having, good process, I think you can actually remain effective and not just reactive.
Thank you, Patrick, for your view. What we tend to hear sometimes, however, is that uh, yeah, one of the key pitfalls that we are is excessive passivity in front of the auditors. And I just wonder if you've been in your career in a situation where maybe the board should actually themselves be more efficient in front of the auditors, and yeah, what the benefit would be, and what sort of, educational gap do you think exists still?
So I think there is a point where the non-audit committee or audit and risk committee members sort of delegate to the audit committee and audit risk. They don't just delegate the work, which is, what you need to do. They seem to delegate the responsibility uh, and the accountability, and they can't because, if we're on the board or if we're a director, we all have, joint and several liability in most jurisdictions. And so, you know, just because we have experts in the audit risk, it doesn't mean that we don't have to know. So one way to overcome this is through a regular, maybe twice a year, get the CFO to explain and the chair of the audit risk committee to explain how the financial dynamics of the organization are changing, what issues are likely to be coming up. What are other people doing? And this has been particularly visible in my world where I'm advising boards and I chair a couple, is seeing how people have thought about dynamic budgeting. Are people being progressive? Are they being sort of well behind the curve, or are they actually, going step by step through this process to keep the risks of doing that sensible, but to take the advantages of it. So I think if you've got a new board member who their strengths are other than on the financial side, then you need to invest in getting them up to speed, not just in terms of understanding, the basics, which most people will have, but also the specifics in terms of the dynamics of that particular business or sector or type of organization. People going into private equity backed situations for the first time are often, surprised by, it's just a very different nature of things that the PE firms might be interested in and the depth that they expect the directors of their portfolio companies to understand on the financial side. So there's a whole lot of things in there. Yeah, thank you.
Thank you for highlighting also about the role of the CFO. Obviously, a role I know very well because I'm a CFO by trade. So effectively giving confidence to both parties, stakeholders, and also the other board members. That leads me nicely to the next question. I wanted to ask you, what is the role that the board should play, just making sure that, okay, it's about compliance, of course, has to be done. But what about meaningfulness for the various stakeholders in the business?
Yeah, so for probably about 10 years, when I was on the operating committee through our group, one of my responsibilities was investor relations, which included, you know, all the presentations to investors, the annual report, those sort of disclosure type moments. And I remember when I started, I mean, my background was as being an investor, so I probably had empathy with investors, and the approach was basically to say, you know, what information is it helpful for people to have, not just to understand and want to buy the stock, so not just from a sales point of view, if you like, but also so they actually understood what the business was, what the dynamic of that business was going forward, what were the key drivers of growth, what were the key risk areas, what might be the areas where performance would be variable from time to time. If you're building a long-term business, you know, you've got to invest, to build capabilities, to build market presence, to build product presence, all the rest of it. So it wasn't just about reporting, the very bottom line. It was about understanding what's coming up. So if you're investing in, launching in new countries, in, a new business unit area, getting them to understand the ongoing business, the sort of repeat business, if you like, and those newer dynamics, and how they were likely to be effective. The other thing I think is that you sort of needs to be one step ahead of where the the code where investors are probably going. So I think the board needs to understand investors. So if you're a public company and you may be joining that board for the first time, I think sitting in on some one-to-ones with the investors is a really great thing because then you will understand, the sort of questions that they're asking of the CEO and the CFO or the chair. Now, most people who join big public companies have big public company experience at a board level or just beneath the board level. So they hopefully will have that. But that's not always the case. And it might be a different class of investors. So there's quite a big difference between, doing a US IR roadshow and, one in other parts of the world. There's quite a big difference between sitting down with hedge fund investors who have a shorter term, not all do, but a shorter term mindset to the long only investors who want to buy the stock and hold it, buy a substantial stake and hold it for a long time. So just as I said before, that it's important for the CFO to talk through with the board the financial dynamics of the business. I think you also need to talk through with them the investor dynamics of the business. So if it's a public company, again, how is the composition, the demographic, if you like, of the shareholder register? How is that changing? And what do we want it to be? So, you can't always choose your parents, people say. And if you're a public company, you can't always choose your investors. But actually, in your communication, you can attract certain types of investors. Should you want to build up that proportion of the register. So I think the board needs to understand, what the composition of the shareholder register is now, what it wants it to be, how, what's the plan for moving from one to the other if they're different. That classic sort of stuff.
Thank you so much, Patrick. And yeah, I mean, the key question here is really, is there enough education for aspiring board members about what such a hub the board is for the various stakeholder? Because obviously I've been speaking about investors, but there are so many other stakeholder in the business, like employees and etc. So yeah, I mean the key question is about education. I mean, in your view, in just a few words, do you think is there a lot of work to be done to ensure that more education is circulated about this?
Yeah, I think so, because I mean, historically, the education for non-execs, if you like, was largely on the duties, responsibilities, you know, those sorts of things. If you look at classic education, you're looking at knowledge, you're looking at skills, you're looking at behaviors. And also because the stakeholder group will vary from organization to organization, you need to have an integrated stakeholder strategy so that you're making sure you're not forgetting about one stakeholder group. So, you might be really focused on your market, which is natural and understandable, but you might not be really understanding your investors, or you might not be really on top of the people issues. So you look recently, you've seen very high churn rates in many organizations. And to some extent, that's because the board has been perfectly happy with the company having a more and more transactional relationship with employees. And then it's surprised when employees, mirror that back and have a transactional relationship with the the organization and don't see it, and they say, well, why aren't they loyal to us? Well, you know, maybe it's because you've encouraged that culture, that climate. If you look at your suppliers, I think one issue a board needs to be really on top of is, what is the relationship with our supply chain? Do they see us as a really valued customer, or do they see us as someone who, batters them down on price, won't let them make any money, so they can't invest, and then moves on to the next one? Those relationships and the way that we approach those things really important. And you saw that coming through in COVID big time, where the companies which had really good integrated stakeholder strategies tended to have a lot more loyalty, a lot more commitment. People would do things for them that they didn't need to do, but they would do because they valued that relationship. So I think it's a really good question.
No, thank you very much. And as we always say in the Exponential Blueprint, we always encourage funders really to think about what makes it a high valuation strategies. And obviously, yeah, we've been speaking about positioning, but don't forget about structure. Structure is fundamental
Mm.
to really go from invisible to investable. And that leads me very nicely to next question is, how do you assess the quality of an organization financial literacy at the board level? Which I know is a very, very important subject for many.
You can tell when you're on a board, you've just joined for the first time, or you're observing a board by the nature of the questions that people will ask, the openness of the finance CFO, the way the CEO and the CFO interact. So, does the CFO actually understand the business? Um, and then I think, in your individual conversations with people, when you get the board pack and you chat with another non-exec, what did you think of this? What do you think of that? If they don't seem to have really read and understood the financial sort of section of the board papers, then that's a concern. So you may need to suggest diplomatically that it might be worth you spending an hour or two with the CFO in the coming months just to understand why that issue is important, why that metric, that whatever it is, has changed, why the auditors are grumpy with us, why you need to understand. And there's nothing like, a high degree of humility. I think a trap that many fall into is they think people expect them to know, and they don't know, and they don't want to reveal ignorance. And no one likes to reveal ignorance in front of other people, really. So often this is about what you pick up in one-to-one conversations. And I think one of the roles I see is that for the chair of the Audit and Risk Committee is to ensure that their colleagues on the board do have a good level of financial literacy and support them in getting more. So, some audit chairs see it as their role to make sure that the board gets regular updates on things. All the major accounting firms, legal firms do, update sessions, and they're usually free, and you can go along and you can meet other people on other boards who probably got the same issues that you have. So I think it's that kind of thing that will really, once you've assessed the quality, is actually help you do something about it.
I thank you for touching on training and also the point you mentioned before about potentially not just in terms of literacy, but also in dissemination of financial information to the business. Yeah, as you mentioned before, it would be useful for the CFO to take the lead and potentially have session, let's say a regular session, which could be, once, as you said, once every quarter or twice a year. I think, that's a very, very valid point. Yeah. And I think, many CFO, should sometimes think about taking more leadership than they normally do. That's my encouragement to many of my peers, I would say.
Yeah. And I think
Mm.
it's a sign of a strong CEO if you've got a CEO who is encouraging of that rather than just tolerant of that.
Okay.
Yeah.
Okay, so let me ask you now this question about risk management. Yeah. Now,
Mm.
I always say, the business only exists because somebody took a risk. Yeah. Um, and after that initial risk, the business has to live with risk forever. So it's not as if risk can be avoided. Has to be calculated, has to be managed. So, in your view, why is risk management fundamental?
Well, businesses, as you've said already, very, very clearly, you take a risk, and the intention is that the return that you get for taking that risk is commensurate with it. Or, in your dreams, you're going to make a higher return than the risk might be because you manage more effectively. I think I wrote a LinkedIn article very recently, and I think it's time to change the way for many boards that we think about risk. I think combining audit and risk, which I was a big fan of, I think now I'm questioning whether that is the right approach and whether it is better to have a separate risk committee. I think for reasons I indicated before. So you get that focus and you get that broader composition of that committee. So you're thinking, you've got the better balance between the financial and non-financial risk areas. The next thing is, it's even more fundamental than it's ever been because of volatility, because of the world that we live in now is much more of a winner take all type market. The speed with which people gain market dominance is much faster than it used to be because the information is more readily available to consumers, to buyers, whether that's business to business or whether it's business to consumer. Um, the next thing is that I think if you look at a lot of risk registers, they're populated by events. You know, this will be a risk if this happens. This will be a risk if that happens. Whereas actually, for an organization, the thing which matters most is the consequences of those events. And so you see many risk registers which are populated by, you know, they're incredibly difficult to read. They're very small font sizes, lots of colors. I mean, it's just very difficult to get the clarity. Whereas if you think about in terms of managing risks, more about the consequences that might happen, you might have six events which might lead to a consequence that you might have, and you're better planning and mitigating for the consequence rather than the event. Most of these events that you put on your risk register, you can't influence the outcome on. The thing that you can most influence is how you respond to a consequence of an event. So let's just take, for example, COVID. So, um, I think I may have mentioned this before, but I was struck at EY by the fact that EY was thinking about one consequence it had in its research was what would happen if we can't go into our offices worldwide today, and that was for a prolonged period. What would we do? And they had that plan and it worked brilliantly for COVID. So rather than having a specific COVID, risk and mitigation, it was actually the thing which will hurt our business would be if we couldn't get into our offices. And so what do we need to do to serve our clients, as effectively as we can and as quickly as we can if that happens. So there was a brilliant plan in place for that, and that was it. The next thing I think there's to do with risk is to do with the differentiation between risk appetite and risk tolerance, and risk appetite and risk tolerance for different types of risk. So, for example, we might actually have a reasonable appetite for business risk, market risk, if we've got a very strong financial position. If we have a weak financial position, then we're less likely to be prepared, or we should be, to take massive business risk. because the consequences would, they may be more life-threatening, threatening to us. And I think often in the way that risk is presented, people talk about a risk appetite in aggregate, and I think that's a mistake. I think we should talk about our risk appetite by, the big categories. Um, and our tolerance is to do with, the degree to which we are in a robust position, not just financially, but, do we have the capabilities? So in an era where many middle management teams have been hollowed out, where we have been focused on lean and these sort of things, do we actually have the capacity and the capability? And that might be directly through our own teams and employees, or it might be through the advisors that we use, the group of people who can support us if something happened. Um, so I think there's a hell of a lot to do in this risk area. And one of the areas, which is what we've been talking about, is, do we have the information flows and can we get information quickly enough so that if this risk materializes, we can respond in the most effective way? If we have to make a decision within a week, but we're not going to get the financial information that would help us make that decision the most effective way for 3 weeks, obviously that presents an even greater risk. Um, and then the other final thing I'd say is that often we focus just on one risk at a time. And what we found in the last few years, I think, is there's a it's quite frequent that there's a combination of consequences driven by events that cause the problem. And so, is our mitigation for this, for that, for another thing, is that solid if two or three of them happen at the same time? So have we thought through, the combinatorial risk, if you like, for that? So I think it's a massive topic. It's really fundamental to business. It's changing, and I think we need to respond and anticipate that. And probably, I think a great topic on a board agenda, particularly as we run up into the end of the calendar year, would be: are we thinking about risk in the right way? Have we got the right approach to risk?
Yesterday, I actually published a weekly edition of the newsletter, edition 32, and it was about risk management. And I mentioned a staggering list of statistic that really supports a lot more thinking about risk. For example, one statistic was that 43% of businesses that are hit by an uninsured loss, they never reopen.
Yeah.
Another statistic was from IBM. IBM estimated that the average loss from a cybersecurity event is $4,450,000. Uh, so this is where really, education is never really enough, shall we say? Also because each business is unique. So you can never say, okay, that risk management approach is okay for that business and it's going to work for the other business as well. Which is why a board director should be 100% immersed into the business. And the other point I was making yesterday was about the insurance program. So making sure that you got an insurance program,
Yeah.
that you'd review it very frequently. What's your view on that, Patrick?
I agree, and most organisations absolutely do that. And it's not just. I mean, the interesting thing as well, if you're an investor, people will say, "Yeah, we have insurance," and I always remember a very important piece of due diligence was making sure that the premiums were paid. Because if the premium isn't paid, you have no insurance. Um, and it's one thing to say, yes, we have a policy for this, but actually, what is the level of cover that you have? What are the exclusions? Understanding that. Yeah, but that again is something, the audit and risk committee should be on top of. Have we got the right level of cover? Insurance is clearly expensive for things, so in cyber, for example, if you look at a lot of the cyber policies, they have exclusions around, well, if the board hasn't done its job, in terms of educating itself about cyber risk. If you don't have the processes in place that are, the following, then there is no insurance. So many people say, "Oh, yes, we have cyber insurance," but well, what is that insurance, and what's it cover for, and what are those exclusions, and what do we need to do as a board to make sure we're fulfilling our obligations under that policy, so that we don't risk it being, an invalid claim if we had to make one.
And the key goal is always to make any failure as small as possible so that it becomes a lesson and is
Yeah.
not going to be a total loss. Thank you
Yeah.
so much for running me through. Do you want to add something else, Patrick?
No, no, I was just going to sum really by saying there is a lot to do here, and realistically, you know, the pressure is high, and so that's why focus, making sure we've got the right advisors, making sure we've got the right team is so important, and that then makes the board's job much easier, and they're much better able to focus on the key and the most important things. If they're filling in gaps because of a weak CFO, or then it becomes very difficult.
Thank you for reaffirming this, and it's really, really important. Okay, before we move to the closing of this podcast, I wanted to ask Patrick, probably some of the most important question, which is about his activity, his current activity, his past activity, and the highly precious educational books that he has written. I just made an example of one book that Patrick has written. It's about board education, and please feel free to tell us more about this book, Patrick.
Yeah, so I wrote boards. I'd written a couple of other books before, but I helped the Financial Times design their board director programs, and do various sessions on that over the years. And they thought it would be really useful to have a summary type book. So rather than pick a board topic, that just from a very practical point of view would be a companion for board directors as they go through their board experience. So the book is basically, designed around purpose, people, and process, just diving deep on those three different areas. Half the book are case studies with real examples that you navigate through the story of the situation. Um, the latest edition was updated towards the end of COVID, so it's not that old. And there's a big focus on the behavioral dynamics, big focus on decision making, for example, and it looks at boards across the world, and also very many different types of organizations. So from startups, growth companies, public companies, social sector, as well as commercial. And yeah, I hope it's helpful. Um, Another book which is more recent is the Five Generations at Work, which came out in the last year. That's about the I think the lost opportunity that's there at the moment, where people are focused in terms of thinking about intergenerational working, about minor little problems in understanding and so on. Whereas there's a massive opportunity with five generations in the workforce to make the most of those different generations. And so that book is about how do you do that? And it looks at examples from, again, right across the world. There's about 6 years of research involved in that, where we looked at what are companies doing, what are organizations doing that aren't commercial as well, to make the most of those different generations. So next gen boards, lots of things in that's really practical. So yeah, and then the LinkedIn articles, I suppose, are probably the biggest way that people will get in touch. So once a quarter, I produce a LinkedIn article on a topic of relevance to boards. So the latest one is around trust. The one before that was around risk. They've been on dynamic budgeting. They've been on um, managing conflict, all sorts of things. So they're the ways that people generally get in touch. And LinkedIn is probably the easiest way these days. So, if you put my name in and boards, you should I should come up.
Now, it takes me back to my education with the Financial Times Board Director Program, where board effectiveness dominated the course. And the fact that you got so many case studies in your book really makes it so fun to read and to learn about, because case studies really are what will teach the most. We can talk about theory all day, but eventually practice, learning from real cases is what you really need. So highly recommend this book. It's really a fantastic source. Because I see so many people, they want to become non-executive director, board directors, but they need the right education. So yeah, no, thank you so much. And obviously in the Exponential Blueprint, we will find a lot more from Patrick. About this, and obviously, it's very welcome to become an expert for the boardroom in general. The other thing I wanted to ask you is about the current activity about ESSA. Tell us more about this, Patrick.
Yeah, so I founded ESSA in 2016, and it was a result of spending quite a lot of time with another charity I'd founded and helped to build called Warwick in Africa, which was teaching kids and te training teachers in slums and in rural areas of poverty in Africa. And one of the things which struck me on the ground, I've been going to Africa for about 20 or more than 20 years now, um, was uh, the lack of evidence-based decision making in terms of making investments in education. So you'd often find a lot of money being wasted. I mean, a lot on edtech in areas where there wasn't electricity, or you'd see that kind of thing, and yet you'd see fantastic examples, usually locally created and driven, which couldn't get any money, and it seemed this mismatch between where the money was going and where would have effect. Now, if you look at the demographics of Africa, and actually that's in the Five Generations at Work book, I think on page 27, you'll see that as opposed to all the other continents, the African demographic is very different. So you have another billion people expected in Africa very soon now. 1 in 4 of the world's population will be African. And that's a massive um, challenge in terms of, you know, economically, there's an enormous opportunity that that brings, but only if you have the right education environment. Um, and so what I was seeing was, there's a capacity issue, massive capacity issue. Most African universities only have half the faculty they currently need. And if you say how many of those faculty can teach in a blended learning way, you making the most of technology, that number would fall even further. Yet you've got another billion people arriving. So what are you going to do? So I formed ESSA with some friends and some great support initially from the Robert Bosch Foundation, but now we have a broad range of funders to basically be an organization which gathers evidence where it exists, puts that evidence in front of the people who are making decisions around policy, around investment, and therefore that will improve the efficiency of investment in education in Africa. We have had a wonderful nearly 10 years now. We've made great progress in a number of areas. So in African-led education research, so giving Africans more power, if you like, in terms of doing research on education. So it's not all education that's been done in the North or the West, it's African-led. Putting that in a free online database so everyone can see what evidence is already there, which also enables you to see where the gaps are, and then helping to fuel support for where those gaps are. So currently we've just made 31 grants to African researchers in a range of different countries on a range of different topics because there isn't any research on that topic. And so we can get better information for that. I'm the only non-African on the board. We have an all-African leadership team. It's a virtual organization. And so we have people across a whole range of different African countries who are doing the work. Sometimes that work is, you know, country specific for their particular country where they happen to be. Sometimes it's for a range of countries, so it might be for six or 10 countries. So, but we could always do with more support because we have, a big list of things that we would love to do that need doing, that we would like to do. So, if anyone is interested in African education and interested in systemic change, then take a look at the website and get in touch. We'd love to hear from you.
Well, one hand has been raised is from the exponential blueprint because we could not be in more agreement than what you have said about education in sub-Saharan Africa. Um, Now, I just mentioned two things. First of all, a big statistic from Goldman Sachs. Goldman Sachs has made some projection a couple of years ago about the economy in 2050 and 2075. Nigeria is on course to become economy number 9 in one generation and economy number 5 in the world in two generations, 2075. Now, that's an amazing situation because you can imagine Nigeria will have a bigger economy than any other economy in Europe. That's, I know for many that will be surprising, but that's what Goldman Sachs are anticipating. The other big country that Goldman Sachs has anticipated is going to be much higher in the range will be Ethiopia. And by the way, Ethiopia early this year, they opened a stock exchange, which is going to be quite interesting to see how that will develop in future. And let's not forget, what we stand here for at the Exponential Blueprint is to help potential entrepreneur to go from invisible to investable. There is a lot of education about wealth management in the world, but what about wealth creation? So that's what we want to help. We want to help entrepreneurs, especially in Africa, especially in countries where there is a desire to learn. So, definitely we would like to really sort of, extend help to you, Patrick, on this mission. It's a very important mission for everyone.
Thank you.
And so let me just remind everyone about the Exponential Blueprint. You can reach us every Wednesday. The Exponential Blueprint is trusted already by more than 22,000 founders, investors, and executives. Currently, my activity is more M&A. I'm actually managing a book of $480 million to make acquisition into businesses in the new economy, clean economy, renewable energy, and commodity production. And don't forget to join our YouTube channel. Currently, there are more than 40,000 subscribers. I'm very excited to always, be able to give a reply to your comments. Do not hesitate to write more about also this topic with what we discussed with Patrick here. The link is to your right, and underneath this video, on just below, you will find the link about how to make the next move. Let me thank very much Patrick for this. And by the way, while we're doing this podcast, Patrick has become grandfather for the second time. Correct me if I'm wrong, Patrick.
Thank you.
Okay.
A little girl. Yeah.
So little girl. So very much congratulations. And we'll be happy to see you on the next episode of the Exponential Blueprint for our podcast. Thank you for your attention today.